In this section, we continue with our discussion on the ecosystem under the wealth management industry. We've already seen who are the major market players and what are some of the terminologies that are used here. Now we'll look at exactly what is the growth that we are witnessing in this particular segment, and what are the advantages a country like India faces or has in this industry. Why is this an important industry? And that would also kind of continue our answer to the question on why is wealth management an important area. And finally, how does the actual money making work in this business? So what is the business driver in this industry? How does the wealth advisor make money in this industry? So that's also going to lead up to what is the biggest challenge that is upon us today when we look at this industry and the requirement of this industry, and how are we going to go about addressing that challenge is going to form a crux of our discussion over the course of this entire curriculum, right? So let's begin with an understanding on some estimates. What is the total investable assets of HNIs across the world? Right? So what is the total size of that investable asset? It is enough to buy all traded stocks in the New York Stock Exchange 10 times, right? So that's the world's biggest stock exchange. And if you want to buy all companies in the New York Stock Exchange 10 times, the total investable assets of HNIs. When we say investable assets, these are assets that can be used to purchase other investments. Essentially, the total investment assets is the tune of the amount which can buy all companies in the New York Stock Exchange 10 times completely, right? So that's the huge amount of wealth that is there, right? If we look at the overview of global wealth management, these are taken from some reports that are available off the web. The global population of high net worth individuals and their wealth hits new high as almost 1 million join high net worth individual ranks, right, every year. So effectively close to 920,000 millionaires. This is a slightly older report in 2014. This number would have continued to expand in subsequent years as well, right? Look at the growth rates. Look at the growth rates essentially in terms of Europe. This number has kind of grown. So there are two ways to look at it. One is the actual population, and the second is the wealth amount. So how much is the population of high net worth individuals growing by, and what is the wealth of high net worth individuals growing by? So there are two ways to look at it. If you look at Europe, for example, the population of high net worth individuals grew at 4%, wealth at 4.7, right? You look at North America, population grew at 8%, wealth also at about 8.1%. Uh, Latin America, there was a decline in this number. But if you look at Asia, that's the bright spot. The population grew up by about 8.5%. The wealth actually grew up by 11%. So Asia Pacific is essentially what is one of the key areas that you're looking at. You have globally a scenario where you have in the world roughly about 2520 millionaires every day, new millionaires every day, right? That's 920,000 divided by 365. So if I take 920,000 and divide this by 365, that's the number. And if you look at the number in Asia, that's growing by about 1,000 millionaires a day. So bulk of the growth of the words HNIs is basically coming from Asia. Asia is the driving area. So that's something we need to be very very focused on. That bulk of the growth that the world is being witnessing in high net worth individual population comes from countries like China, India, and other Asian nations. Right? Let's look at the crux of these countries now, right? So when we look at this overview of global wealth managers, what is the number of new high net worth individuals in 2014? And the top four markets are US, Japan, Germany, and China. And 60% of the global population, 60% of the global HNI population comes from these four countries: US, Japan, Germany, and China. So they are good places where high net worth individuals would exist, and that's logical as well because US, Japan, China, Germany are practically the four largest economies of the world. When we look at absolute GDP numbers, these are the four biggest economies of the world, right? However, what is interesting is if we look at India, where is India? So this is India, and the number of the HNIs essentially has grown in India by 26% in 2014. If you look across the countries, that's the fastest growth rate that you've seen. China has grown at 17, India has grown at 26, and combined India and China is what is really driving this entire growth in HNIs. So India, we see a 26% growth in HNI population, right? High net worth individual population. So that's a remarkably big number that is coming out in terms of growth we are seeing every year. So disposable income is increasing significantly in India, and that's helping India become one of the major markets. So let's look at what is the advantage that India carries in this market. Why is this market a very important market for India? So first is the growing HNI population, the highest growth in the world of 26%. This is of course 2014 data, but the numbers continue to grow in terms of new millionaires added in India every year. This is one of the fastest growing markets, right? India's savings to GDP ratio. So savings to GDP ratio is close to about 25 to 30%. With a GDP of 2.2 trillion dollars, right? That's equivalent to 2200 billion dollars. If I take about 22, 25% of this, approximately today this number is 600 billion dollars. That's the savings we do, right? Today, bulk of these savings basically go into areas such as real estate, it goes into gold, or it stays into the banking system. Right now, because a lot of the movement is happening in terms of technology advancements and people are becoming aware of investments, that will start moving in logically towards the wealth management industry. This itself is presumed to be growing to close to 1200 billion by 2019, right? So savings are expected to increase dramatically. Assuming that out of these 1200, 30% goes towards wealth industry, right? Rest can stay probably in the traditional formats of gold, etc., where people don't really take an advice. The total industry is going to be worth about $400 billion. If you look at $400 billion worth of an industry, which is the wealth management industry in India, if you were to put this in the GDP ranking, this would be the 30th largest country in the world. $400 billion, right? So practically there is a huge amount of wealth that is available in India, which will get utilized in terms of investments into financial markets. And because this will get channelized in the financial market, wealth management will be required dramatically. A lot of money in India is actually untaxed money, right? So the initiatives by the government on curbing this will help organized investment segments. And again, because for black money, you can't really disclose it. It doesn't go out into the open. Once it is taxed money, the requirement of wealth management increases further. So this is additional money that will come in. So whichever way we look at, there is a significant advantage that India carries in this market. We are anyway showing the highest growth in HNI population. Our savings to GDP ratio is going to rise dramatically, is at a high number, and that number, because GDP will rise, savings number will also rise dramatically. Traditionally, we have been in real estate, gold, and banking. That's because of lack of awareness. And now, as awareness about these products increase, a lot of the people, even younger generation like us, when you get a job, you'll start probably saving some money and probably put some of this money in mutual funds and would be primary candidates of the wealth management industry at some point of time, right? As a customer. And then the black money, which is untaxed money in India, once the tax net widens, possibly that would result in a significant gain in terms of a lot of money moving from these channels, the channels which restrict the flow of money into financial markets essentially, and that would again require some sort of a wealth advisory, right? Now that's the entire context of wealth management industry in terms of numbers. Now, what is the importance of wealth management essentially? If you look at high net worth individual, although HNIs do not have a single source of social impact advice, a lot of them, they kind of seek advice. So 30% of them look at wealth managers, 27% get it from family members, 22% essentially get it from friends. So not everyone goes to a wealth manager essentially, right? So if you look at the percentage of respondents in terms of where do they get their advice from, some go to family, some go to a wealth manager, some go to a friend. A lot of them don't go anywhere. So this is the lot which is essentially unadvised, and this is the potential market which can come immediately to the segment in terms of the percentage of respondents that can essentially advise in terms of the wealth management industry, right? And global wealth is forecast to reach $70 trillion by 2017. So that effectively is a huge amount that can be tapped in terms of the wealth management industry, right? So that's the crux of how the wealth management industry is shaping up. What is the mathematical advantage of possibly looking at this industry? Now let's understand how does the system work here, right? So there is an investor who wants to invest. This is typically an investor who's unaware about the markets. So there is an advisor who advises the investor. So the investor gets advice from the advisor. The advice could be invest in XYZ mutual fund, right? Some fund. You have to invest in some fund. Based on this, XYZ is the product manufacturer. So let's say this is XYZ. Based on this, the investor allocates money based on the advice because the investor was unaware. There is an advice given by the advisor, and the investor invests, let's say, 100 rupees based on this advice in XYZ's fund. Now, traditionally, historically, the way this industry used to work was this: out of this 100, roughly about 2 rupees was paid out by the product manufacturer to the advisor, right? So technically, the investor invests 100, the product manufacturer pays 2 to the advisor. Final investment, how much is the final investment that is left? That is 98. So in a way, it's the investor who's paying, right? The investor is paying because it's going out from his money, but the payment is happening unknowingly. The investor does not know that he is making the payment to the advisor. That creates a skewed scenario. That creates a skewed scenario because if tomorrow there is another producer, let's say LMN, who says, I'm going to give you 3 rupees out of the 100 that investor invests, there is a likely scenario that the advisor will go to the investor and say, look, XYZ is not good. XYZ is not good as a product now. It's not doing well. So let's invest here. Now think about it. You first put in 100 rupees, out of which the advisor made 2. You were left with 98. Now you take out that 98, effectively put that in LMN again now, and the advisor makes another 3 out of it. What is left is 95. So out of 100 rupees worth of investment, 5% is already gone to the advisor. And logically in this scenario, when you look at the mechanism of payment, where is the loyalty going to lie? Right? So where is the loyalty going to lie? There is a skewed incentive structure and there is a lost trust issue. Why is that? Is because the investor is getting advice but is not being paid here. So that's where the loyalty will be. And that's the biggest problem of this industry today, is because the advisor gets the revenue from someone else and gives the advice to someone else. This is the guy who's getting affected by the decision. But this is the guy who's effectively making the payment, right? Making the payment. So if you are an advisor, should you look at the responsibility you carry towards your investor because it's their hard-earned money, or should you look at your revenue because you are running a business after all as well? And in that rat race, what ends up happening is you focus on your revenue. The moment you focus on your revenue, if the advisor focuses on the revenue, the investor will eventually lose out on the entire game, is because the investor gets advice which is skewed by the advisor's loyalty towards the product manufacturers. So bad products, in other words, we are saying that bad products can get sold, because of this structure, because of payment structure, right? And think about it. If the product is bad, the product manufacturer will be willing to pay more because otherwise you will not be able to sell the product. Correct. So that's effectively the issue in terms of the skewed incentive structure. And that's why in India at this point of time, you have a big issue in terms of mistrust. Clients do not trust financial advisors. You don't trust your bankers. You don't trust anyone who comes from the financial services industry and tries to advise you on any product, right? What is the best model in this case? Ideally, what should happen is there should be no connection here, or there shouldn't be a mechanism of payment being made from the product manufacturer to the advisor. There should be a direct, transparent advice that gets given here and direct, transparent payment that gets done here. So effectively, what should happen is you get the advice, you pay too if you believe that the advice is valuable. So effectively, the investor pays, but now pays knowingly. And that will only happen if advice is valuable or if advice is worth it. Otherwise, it will not happen. So if you remove this structure, that's where the fee-based advisory model comes in, where the investor says that, look, for every 100 rupees that you invest, the advisor says that for every 100 rupees you invest, I will take a fee of 2 rupees, right? Regardless of where it goes. Now, if that too gets fixed, the advisor effectively is certain of revenue, right? So advisor is certain of the revenue that can be made, and the advisor does not have to resort in some sort of activity that he was doing here, where the advisor was trying what is known as revenue maximization, right? So the advisor can maximize the revenue basically by selling a product that may not be good. In this case, the only way to maximize revenue is to increase 100 to 200. If 100 becomes 200, this 2 becomes 4, and 200 becomes 400, this 4 becomes 8. So the model is basically based on trust. Money will increase only if the advisor makes money for the investor and if the investor believes that the advice is valuable. And that's the new model that is coming up in this industry. A lot of the, if you remember, we had discussed about the boutique firms, the smaller wealth management firms, they're all going on this fee-based model where they are basically charging a fixed fee, which there are multiple models. We'll come to those models in subsequent sessions in terms of how people are charging these fees. But this ensures that if there is no linkage between the product manufacturer and the advisor, if you can cross off this linkage somehow, that becomes the biggest change in the industry to increase and enhance trust in the industry, right? Trust is the key. In terms of your understanding on expected level of advisory and actual advisory that you get, if you look at respondents, what kind of services they believe they should get and what kind of services they get, there is a gap in that. That gap basically comes here. So there's a difference. In fact, one of the biggest issues is sometimes you try and make a search in Google and you just type the words how to find a trusted, and Google obviously throws results based on what has been the topmost searched item in the recent past. That's what you see a lot of the times, is because around important events like tax filing, etc., people look at how do you find a trusted financial advisor. That's a rarity. So there are two things here. We see that the wealth management industry is growing. It is changing because of the dynamics of payment structure in this, and there is a requirement of trusted and knowledgeable, knowledgeable knowledgeable wealth advisors or wealth managers in the industry. There is a big requirement of someone who has both the knowledge and who can win the trust of the advisor. And that is why this is a very fast growing industry producing a lot of jobs. But if you have the knowledge and if you have the ethics around the industry, you care for the customer who's investing his or her hard earned money, you have all the makings of becoming a successful wealth manager, wealth advisor. This industry is much beyond the traditional mechanism of sales industry in the financial services scenario. This is now a much more knowledge oriented industry, right? That's it in this segment. In the next segment, we're going to discuss about specifically what are the regulators in the industry and how the regulation has changed in the industry based on what has been the payment structure. So obviously the regulator has also taken note of this entire scenario in terms of who makes money and what are the mechanisms that are available. And that's where the crux of the new changes in the industry come in, right? That's it in this section. Couple of quick questions. Explain how the wealth management industry works. How does the advisor make money today? Also discuss about what is the new mechanism that we are looking at. What is the growth rate of high net worth individuals in India that has been witnessed in the recent past?